Good afternoon, traders. Welcome to your 7-minute market update, utilizing technical analysis to predict direction based on human emotion. Today is May 19th, 2013. Not too much to talk about, but let's definitely get started. This is a chart of the SPY. This is a daily chart. The SPY is the ETF that tracks the S&P 500. All right, let's just get right into it. I don't want to make this video too long. I'm not feeling very well, unfortunately, but hopefully it's just a cold and not the flu, and I can just fight this thing and get back to trading. In any case, so we had this 165.80 level here. We actually pierced through that on Wednesday, and then on Thursday we actually opened, gap down and opened at 165.78, which was about 2 cents off, and then it's not so bad. I had actually shorted the market at this candle here at 65.80, and I was in the money. Unfortunately, I had to get stopped out break even. So that, well, actually, it was break even, but it took a very tiny loss because it was actual gap up the next day, which was Friday. So Friday's move was a big move up, and the move happened on pretty sufficient volume. So this is a validated move in my opinion. However, we would still need to see something that closes above that. Now, just keep in mind, you see this upper trend line over here, this one over here. This is one that we have to keep an eye on, and I've discussed this with you guys in the previous videos, that this could lead into pretty good resistance here. I said the 165.80 should have some sort of resistance, and it did for Wednesday and Thursday, but then it continued higher, and we could actually see some resistance up here. Now, just keep in mind that I think that for the most part, we should at least see a small pullback, at least into the 20 moving average, after we hit this upper trend line here. I just honestly can't see it going any higher than that. But with the way the market is going and the way the Feds are printing money, you just never know. The power of the Feds and the power of manipulation is a lot more powerful, obviously, than technical analysis, I should say. But as long as we keep ourselves safe, as long as we know manipulation is in the market, and so we will keep ourselves safe with stop outs and utilizing a strategy that puts the odds in our favor, then 9 out of 10 times we'll be right, and that one loss, as long as we have that stop loss in place, will be a small one, and we can continue trading and profiting off of this market. So again, there is a possibility that we hit this trend line up here and then see a small pullback. Possibly, I mean, I really think that we would really need to get into that 20 moving average, a retag or a retest at least of the 20 moving average. If we do decide to go higher, we need at least this pullback. I mean, this straight up type of action that we've been getting in the markets is just really, to be honest with you, not a very healthy thing to see. When you see this kind of move straight up like this, that normally follows a correction, but I've been seeing that for weeks now, and it still has not happened yet. And every time the thought is that we would correct, Uncle Ben comes out with news basically saying that if there's any pullback in the markets, then they will initiate another $1 trillion. I'm exaggerating, obviously, but not really. But printing more and more money, and again, the more you devalue the U.S. dollar, the higher the markets will go, and that's why the dollar is inverted to the market. Now, the dollar has not been 100% inverse to the markets as of late, but we still need to keep an eye on that, because when the markets do fall into place and it does start correcting, then that should coincide with what the dollar is doing. So we just need to keep our eye on that for now. We are still seeing divergences in the markets in every oscillator that you look at. The RSI, the MACD, the ultimate oscillator, all those oscillators are showing some sort of divergence, and so that's what you would also need to worry about. Divergences, in my opinion, some people rely on divergences to hold true in the short term. For me, I just use divergences as a warning sign that of what may soon come, but there is no time on when that will come as far as when a divergence appears. So when you do see a good reversal pattern with volume and everything else, then that's normally when the reversal will start and coincide with the divergence that we've been seeing. Okay, so, and I know I talked about this in the previous video, so I won't get too much into it now before this video takes too long. I know I posted in my Facebook or in the Facebook that I would have another mathematical calculation based on patterns on the daily. That 165.80 is the max number that I could come up with on the weekly. And again, I have no reason to lie to you guys because I'm not making money on any of this stuff. But even on the weekly pattern, I have no calculation above the 165.80 level. And the monthly patterns, the 165.80 level is the very highest level that my calculations has spit out. It spits out a total of 12 numbers, and any one of those 12 numbers will be support or resistance. As you can see, all of these here, all of these pink lines are based off of that calculation, that's formula. And we all know from watching these videos that the formula has been pretty darn accurate, or pretty, pretty close. But the interesting thing is I've never actually seen the formula ever in my life. And it's been over a year. This will be the very first time where the highest number of what the formula has calculated, that the market has gone above that number. Okay, so I don't know if that's a sign. I don't know what it means. Again, this formula I created is just a little over a year old, and that remains to be seen as to what may happen. Now, this upper trend line here, this trend line was on the daily chart as from what we just saw earlier. Let me just switch. Alright, so this is the daily chart again. This is the upper trend line, and let me switch to the weekly chart now. Alright, this is the weekly chart. This week was a bullish week. I mean, we had this nice move up here. It was not, keep in mind, was not on high volume. So just keep that in mind, that move up was not on high volume, but it was in fact a bullish week. We cannot deny that. And we cannot fight the markets. We cannot say, no, the market is not supposed to do this, because if the market wants to do it, it's going to do it. And we need to be able to figure out, or I need to be able to figure out, using technical analysis, what the general population of traders are thinking. And that's why technical analysis holds truer than fundamentals, because regardless of how good a company is doing, or the general market, it really depends on what traders are thinking. Even if our economy is really not doing good, even though I think printing money till till the dollar is worth 1 cent is probably not a good idea, the fact remains, because of it, the markets are pushing higher, and we need to play that, or I need to play that. So am I bullish? No, I'm not, and I haven't been for a while, and it's because I think that there should be at least a pullback. I'm thinking correction. A correction would be great. Okay, I think a correction would be very healthy for the markets, but a pullback is at least needed. We've had 4 weeks, 1 whole month straight of up candles there, and we're gonna need some sort of pullback, and I think that's gonna happen sometime next week. Okay, however, that's obviously just my opinion. Last week obviously was the 3rd week of the month, or I should say the 3rd Friday that landed on the 3rd week of the month, which means that options expired last week Friday, and well, actually expired on Saturday, but the last time you can trade options contracts was on Friday, last week Friday. So that whole week, which was last week, you're going to see a lot of volatility, and that's what we've been seeing. And again, if you're new to watching these videos, sometimes I don't mention it in my videos because sometimes I forget, but just remember this: every 3rd Friday of every month is the last time, or the last day, that you're able to trade options contracts, and Saturday following that Friday, the contracts actually expire. So a lot of institutions and a lot of companies are the ones who write the contracts. Retail traders will write contracts, but the companies out there, hedge funds and stuff like that, they're the ones that are actually writing these contracts, and they need to manipulate the market in order for those contracts to expire worthless. And they're going to do everything they can. They have computer programs out there that can calculate what is the best price that a particular stock or market needs to be at for them to lose the least money and or make the most money. And then you have what you call price pinning or stock pinning, whichever you want to call it, and they'll pin the price at a specific amount, just to ensure that your option expires worthless. Because with options, you have to remember there's theta, there's delta, there's Vega, and there's a whole bunch of other things. I rarely trade options nowadays because of these variables, and theta is the biggest biggest one. As time goes by, your options deplete, and the longer out you buy your options, the more expensive it gets. Sometimes the way the market manipulation has been happening today, it's sometimes not a good idea to play options, at least in the short term. If you want to buy 6 month to 8 months to a year type options, then that's fine, because Theta won't eat you up alive, or even Vega won't eat you up alive that much. But again, as you get closer, Theta becomes more volatile, and you'll lose a lot more just holding on to the contract. Okay, so anyways, I'm gonna stop babbling about options, and I'm just gonna let you know that that's why normally the third Friday of every week of every month, that week is very volatile. So that was last week, and this could be the result of that. So that's just something that we have to look out for. This is the weekly chart, and let me just zoom out here to 20 years. This is the weekly chart of the SPY. Let's just zoom out here, and then this trend line comes from this pivot, this pivot, this pivot, this pivot, and now we're going to have potentially, not 100% guarantee, but potentially another pivot. Now when you have somewhat of a rising wedge pattern such as this, it's rare that you see a breakout. But if you do see a breakout of a rising wedge, what you will normally see is a big crash following suit. Okay, so just keep that in mind, that that's normal. I have examples, but I'm not going to post it up on this video right now. I think I have to go look for it, but I've seen this pattern happen before. It's not unusual to see that happen. If we break out here, I'm gonna say that it's potentially going to be what you would call a not a fake out, but there's a term for it. Sorry, I'm not feeling very well today, but in any case, just watch out for that. A lot of people, when you see a breakout of this trend line, because I'm not the only one that sees this trend line is pretty obvious. I'm pretty sure everybody else, everybody's mother's uncle is looking at this trend line here, and is probably going to short the market here. So the institutions will pop it higher. I'm just zooming in. Institutions will pop this higher. Sorry, there we go. Institutions will pop this higher to stop out anybody who takes a short because of this trend line up here. And then once that happens, they'll just bring the markets down. When the markets do come down, if they do, and again I say if, because nothing's 100% guarantee, if we do get a pullback, this will be support. This will be a support line here, and then we'll just have to see if we make lower highs and lower lows, or if we continue with the higher highs and higher lows. As long as we continue with higher highs and higher lows, that means this market is still in an uptrend. It's an overextended uptrend, but you can't fight the market. It is what it is, and as long as it's an uptrend, you can either play the trend or you can play it cautiously, because that's what I'm doing. I am not playing the trend right now. I'm playing very cautiously. If I do go to the upside, if I do play the upside, it'll be with individual stocks and not the actual market itself, because I think the market is due. I mean, it has to be in order for it to stay healthy, and I really wish it did. I really wish it did correct, because if it doesn't, it's just going to be really bad as for everybody as far as our economy goes, and that I just don't want to see that. It'll be money in my pocket, but you know, it'll be money in our pocket, I should say, but you know, that's just bad in general for the economy if they keep doing this, because sooner or later you're gonna see a fall. That's not 100% guarantee though. Okay, it's just my opinion. It doesn't mean it's gonna happen. As far as I can tell you, technical analysis based on that purely, it's still in an uptrend, and therefore the trend is your friend. And as long as the trend isn't overextended, in my opinion, you can follow the trend. All right, switching over to the SPY monthly chart. Okay, we have a again, we don't have a pivot really here, because this is the monthly, so I'm just going to delete this. But we do have a pivot here, and we have two pivots here. And then now we could potentially be making one more pivot there. Okay, so just keep that in mind. Now, any rising wedge, this is a common pattern, rising wedges, right? Everybody knows what a rising wedge is. Let me just delete all the drawings here. This is a rising wedge. Right, we all know what a rising wedge is. Rising wedges, when it breaks, we gotta watch this bottom trend line here. When this bottom trend line breaks, we get the middle of the closest pivot to the middle. And you guys see me do this kind of analysis before, and it's worked pretty accurately. When it does break out, wherever it does break down, I should say, wherever it breaks down, don't know where, could be all the way up, I don't know, into the 200s, who knows. But when it does, we're gonna see the result of it being at least down to this area here, which is around the 120 area, if it breaks down soon. But if it reaches, if it keeps, as it goes higher, obviously the middle pivot will change. This will be in a middle pivot for now, but in any rising wedge triangle or descending wedge or triangle, symmetrical triangle, the closest to the middle pivot is where you get your calculation, and this has worked time and time again. You can rewind into my previous videos if you wish, but this should be the minimum breakdown when we have a breakdown of the bottom trend line, and that remains to be seen. I don't know if that will ever happen, especially with the way things are going, but you know, we definitely need to keep that on the radar, and just play it safe. That's all. If you're gonna go long, just have your stops in place. That is all. And if you're in the money, you know, make sure you lock in those profits. Not, you know, you don't necessarily have to sell the stock. I mean, just put a trailing stop in there if you want, but take your profits, because a good example is Apple. A lot of people held on to Apple when it started breaking down from 680 or something like that, or 700, and then you know, now they're stuck with a $400 stock. And people who actually bought Apple, you know what, let me just switch to Apple here. This is the daily chart of Apple. People who bought it here are holding on to it, and they've lost, you know, a ton of money already. Okay, so you want to put your stops in place. Wherever you decide to put your stop, stick with it. Don't change your mind. I mean, whether it be here, here, doesn't matter. Just any one of these. I mean, don't say, okay, I'm going to put a stop here, and then that, you know, I'm going to sell it. But then when it reaches to this price, you know, you think to yourself, well, you know, maybe I'll hold on to it for a little while more, and then you hit this price, oh well, maybe I'm going to hold on to it for a little longer, so on and so forth. And now it's already down to 433 bucks. Again, I'm a short-term trader, so I need the capital to trade. My trades are short and fast. You're talking about days. They're not day trades, but you're talking about days, meaning a few days, at most a week, depending on how things are going. But as just make sure that you have your stops in place. And if you're in the money, for example, you bought Apple here, and then it got up to here. I mean, what you want to do is put a stop at your previous pivot, and then so if it breaks down from this pivot here, which is a double bottom, if it breaks down from the double bottom, then you should have stopped out, and you would have made, you know, you would have cashed out and locked in profits. Had you bought it around here, and then you let it continue to drop because you thought it was gonna go higher, you let it continue drop. Now you used to be in profit, you were making money, and all of a sudden you started losing money. So that's the worst case scenario. There should be no excuse for that to happen. Once you're in the green, you should not be in the red for that specific trade. In any case, this is your 7-minute market update. Again, thank you very much for watching these videos, and I honestly do appreciate anyone that hits those like buttons. It just gives me a little bit more motivation. You know, I'm not monetizing these videos or anything like that, so it really doesn't give me anything financially. I do have that Facebook page up. It's called 7-Minute Market, and feel free to hit the like button on that Facebook page, so anytime I update, I have intra-week updates, you know, with screenshots and stuff, then I can easily post that to the Facebook page, and you guys will get updated sooner than when I post these videos here. In any case, again, thank you very much. Good luck to your trading next week, and God bless to you all, and I hope to see you in the next video.